Is the fear of a sudden market crash keeping you from diving into the exciting world of cryptocurrency? Or perhaps you felt the sting of selling too early, missing out on massive gains. What if I told you there's a way to participate in crypto trading with greater confidence, to automate your risk management, and even to secure your profits while you sleep? Today, we're going to demystify two incredibly powerful tools available on the Gemini exchange: stop loss and limit orders. These aren't just fancy trading terms, they're essential strategies that can transform your crypto trading experience, helping you navigate the volatile waters of digital assets with far more precision and peace of mind. For many newcomers, the allure of crypto is often accompanied by a significant amount of anxiety. You see the incredible price swings, the stories of overnight millionaires, and the equally alarming tales of devastating losses. It's a wild west, no doubt, but that doesn't mean you have to ride blindfolded. Stop loss and limit orders are your compass and your safety net. They allow you to set your boundaries, define your profit targets, and execute your trades automatically, even when you're offline or asleep. Let's break down why understanding these orders is crucial. Imagine you've invested in a promising new altcoin. You're bullish on its long-term prospects, but you also acknowledge the inherent risk. Without a stop loss, a sudden market downturn could wipe out a significant portion of your capital before you even have a chance to react. Conversely, if that altcoin starts to moan, you might be tempted to hold on indefinitely, only to see the price retrace before you can lock in your profits. This is where limit orders come in, allowing you to set a predefined selling price to automatically secure your gains. But it's not just about mitigating risk or securing profits. These orders also introduce discipline into your trading. Emotional decisions are often the most costly in crypto. Fear of missing out, FOMO, can lead to buying at the top, and panic selling can lead to liquidating your assets at the absolute worst time. By presetting your stop loss and limit orders, you remove emotion from the equation, ensuring your trades are executed based on a well-thought-out strategy, not on impulse. Now, let's get into the nitty-gritty of how to actually use these powerful tools on the Gemini exchange. We'll start with stop loss orders. A stop loss order is an instruction to sell an asset once it reaches a certain price, known as the stop price. Its primary purpose is to limit potential losses on an investment. Think of it as your insurance policy against significant downturns. On Gemini, when you place a stop loss order, you are essentially telling the exchange, if the price of this cryptocurrency drops to X amount, sell my holdings at the market price. There are a few key things to understand about stop loss orders on Gemini. Firstly, a stop loss order is not a guaranteed execution at the exact stop price. When the stop price is triggered, it converts into a market order. This means your order will be filled at the best available price at that moment. In highly volatile markets, there can be slippage, meaning the execution price might be slightly lower than your stop price. This is crucial to remember, especially during flash crashes. Secondly, you'll need to specify two key parameters, the stop price and the amount you want to sell. The stop price is the trigger. The amount is how much of the asset you want to offload. Let's walk through an example on Gemini. Imagine you bought one Ethereum, ETH, at $3,000. You want to limit your potential loss to 10%. So, you decide to set a stop loss at $2,700. To do this on Gemini, you would navigate to the trading interface. Select the ETH/USD trading pair. Instead of a market order or limit order, you would choose stop order or stop loss order depending on the interface version. You would then input $2,700 as your stop price and 1 as the amount of ETH you want to sell. Once you confirm this order, it will remain active until either it's triggered, you manually cancel it, or it expires, though stop loss orders on Gemini are typically good till canceled by default, meaning they remain active indefinitely unless triggered or canceled. When the price of ETH hits or falls below $2,700, your stop loss order will activate, converting into a market order to sell your 1 ETH. This helps you prevent further losses if ETH continues to decline. Now, let's discuss another powerful variation, the stop limit order. A stop limit order combines features of both stop and limit orders. It allows for more control over the execution price compared to a simple stop loss. With a stop limit order, you set two prices, a stop price and a limit price. When the asset reaches your stop price, a limit order is automatically placed at your specified limit price. This means your trade will only be executed if the price is at or better than your limit price. The benefit here is that it prevents the slippage that can occur with a market stop-loss order in volatile conditions. However, the downside is that your order might not be filled if the price moves too quickly past your limit price. Let's revisit our ETH example. You bought ETH at $3,000 and want to limit your loss. Instead of a simple stop loss, you decide to use a stop limit order with a stop price of $2,700 and a limit price of $2,690. On Gemini, you would select stop limit order. You'd input $2,700 as the stop price, $2,690 as the limit price, and 1 as the amount. If ETH drops to $2,700, a limit sell order for 1 ETH at $2,690 will be placed. If the market price is at or above $2,690, your order will be filled. If the price plummets rapidly below $2,690, your order might not execute, leaving you holding the ETH. This is the trade-off, more control over price, but a risk of non-execution. Choosing between a stop loss and a stop limit order depends on your risk tolerance and the market conditions. If you prioritize guaranteed execution over a specific price in a volatile market, a standard stop loss might be better. If you want more control over the execution price and are willing to risk non-execution, a stop limit order is a good choice. Now, let's shift gears and explore the equally important limit orders. While stop-loss orders are primarily for risk management, limit orders are your tool for precise entry and exit points, allowing you to buy low and sell high. A limit order is an instruction to buy or sell an asset at a specific price or better. When you place a limit order, you're setting the maximum price you're willing to pay for a buy order or the minimum price you're willing to accept for a sell order. Your order will only be filled if the market price reaches your specified limit price or a more favorable price. This is a stark contrast to a market order, which executes immediately at the best available price, regardless of what that price is. With a limit order, you become a maker on the order book, providing liquidity, as opposed to a taker who removes liquidity with a market order. Let's consider an example of a buy limit order. Suppose Bitcoin, BTC, is currently trading at $60,000, but you believe it will dip to $58,000 before continuing its upward trend. You don't want to constantly monitor the market, but you want to seize that buying opportunity. With that said, thanks for watching and until next time.